Good afternoon. Welcome to Midcap Radar. I'm Reema Tendulkar. With me is Sonal Boothra, and these are the top stories at 1:30 p.m. Stocks slip after a strong start, with pharma, IT and energy leading the decline. Realty, FMCG exhibit resilience as do midcaps. A milder but still hawkish Fed and China concerns weigh.
So now BLW Precision Forging slips after a block deal. Blackstone likely to have sold about 14% of its 34% stake in the company. The partial stake sale leaves the option of more sell downs in future.
Sangam India surges on positive management commentary. CFO and Director Anurag Soni tells CNBC-TV18 demand should pick up starting Q3. The company expects a strong showing in the second half of the year and sees exports growing 20% for the year.
Mahindra Lifespaces continues to surge on its strong business update for the first quarter. The numbers were reported back in July. They are targeting 2,500 crore rupees worth of bookings by FY25. MD and CEO Arvind Subramanian tells CNBC-TV18.
Power soars on orders worth 6,000 crore rupees from the Adani Group. Well, let's invite the management of Nitin Spinners on the show now. They've reported a weak set of numbers. The gross margins have taken a hit. Dinesh Nolkar, the managing director of Nitin Spinners, is now with us on the show. Mr. Nolkar, my first question is on the gross margins. They've declined a fair bit. Do you see them normalizing, and if yes, when, and what will drive that?
Thank you for having me on the show. As we can see, the margins were pretty good in the last financial year. We had a margins around 23-24% operating margins, which has come down to about 15.5% during this current quarter. The prime reason was the volatility in the cotton prices. We have seen a lot of volatility, prices first going up very sharply and then coming down. And then there was a steep disparity between Indian cotton prices and the international prices. So that has actually led to a lot of margin erosion for us. So we hope that we have in the meantime, in the last 2 or 3 months, we have seen that international prices have come down substantially. And whereas Indian cotton prices have not come down that substantially. Hence, if you see, the international cotton prices have come down by 35%, whereas Indian cotton prices are down only 15%. With the new crop coming in from October onwards, we expect that both the parity between the Indian cotton prices and the international prices will be achieved. So accordingly, then the margin should come back to the normal levels.
Mr. Nolkar, good afternoon. Well, that is what my question was going to be. There is a disparity. In fact, the Gujarat Spinning Association had written a letter where they said that because of this disparity in international and domestic prices, they are seeing cash losses as well in their spinning segment. By when do you expect it to ease out? What is the difference between the two prices, that is international and domestic? And considering that you say that it will stabilize in, say, second half, what kind of margin picture are you looking at for your own company?
Normally, once this margin stabilizes, once this prices stabilizes, the normal margins in the spinning industry are in the range of 16 to 20%, depending on the kind of product mix you are having. So which has been, we have been continuously stating that this is the margin which is more sustainable going forward. So accordingly, we expect by November onwards, once the new crop comes in full flow after Diwali, we expect that the cotton prices will normalize. And accordingly, the yarn prices will also settle down accordingly, and we should see a normal second half.
Just a bookkeeping question. What is the current difference between the international and the domestic prices of cotton?
As of today, we are seeing that the New York futures, which is about 113 cents per pound, and the Indian cotton is about 145 cents per pound. So there is a difference of about, let's say, 17 to 18% differences there.
Okay.
So 16 to 18%. Can you talk a little bit about exports? Your exports have taken a hit. What is the ideal mix between domestic and exports that you anticipate for FY23? Which are the markets which are under pressure?
Normally, we have been exporting, if you see for last 4-5 years, we have been exporting nearly 65% of our products and 35% is for domestic market. So in last financial year, the markets internationally was very good and demand was very good. So we could go up to 72% in the last financial year. But that is not the benchmark. we should be considering, given our product mixes, 60-40 ratio, 60% exports and 40% for domestic market. At the moment, we are seeing the retailers all around the world are just withholding their purchases because of this volatility on the cotton prices. The cotton prices have come down substantially. They are feeling that if they buy now, they will be settled with a very high value yarns as well as fabrics, which may dent their margins. So there is a withholding, means the inventory pipeline is getting empty, and we could see the resumption in the orders coming very soon. Plus, apart from this, we are also seeing a lot of inflationary effect coming into Europe, which is one of our major markets. And we are seeing that because of the currency adjustment, and because the euro used to be around 1.10 to 1.15, which is around 1 euro to dollar parity has been achieved. Also, we have seen that prices, because of inflation in Europe, is increasing substantially. So this is maybe readjustment of the prices is also happening there. Plus US, there is a fear of recession, which may or may not happen. But the retailers have already slowed down their purchases. Okay. We expect all these things to be normalized in the coming times. So retail sales, as you can see in India, as well as overseas, is happening as it is. But there is a fear psychosis which we have to take care of anyway.
Yeah. So since we are expecting recovery, of course, a lot has happened in the export markets as well. It was around 70% of your FY22 revenues, but now you said 60% is the normalized export contribution that should be. In that case, what is the revenue growth you're expecting just in the export markets in FY23? And overall, what is the revenue guidance that you can give us?
This year, since we are not, we have run for nearly full capacity during the last year, and we will be just adding a very small capacity during this particular year. But still, we expect with our efficiencies, operating efficiencies and other things, we should be able to grow by about 4-5% this year. Going forward, our expansions are already on the way. So from FY24 onwards, we should see substantial jump in our revenues. As far as exports is concerned, I think it will be, in fact, very hard to match the last year's export levels because they were very good. We had done more than 1,900 crores of exports last year. So I think we will not be able to reach that level particularly this year.
So if the global retailers are withholding their purchases, are you stuck with a lot of inventory because you're still producing as much as you can? Your capacity utilization is healthy, but you're unable to export it. So what is the inventory level that we're looking at, and is it higher than typical levels?
Definitely, it is higher than the normal times, but we are pushing more in domestic market. Domestic markets are far better than the international market. At this moment, there is a very good demand coming from the domestic market. So that's why we are already focusing more on domestic. At this point of time, the domestic to export ratio is about 50-50. So we have been able to push various products in the Indian markets.
You said in Q1, at least the ratio was 60-40. And you're saying it's going to be 50-50 going ahead in the current quarter?
Yeah, it is. At the moment, it is about 50-50. We aspire to keep it 60-40. That is what it was 70-30 earlier. At the moment, it is running at 50-50. But we aspire to keep it as a balance around 60-40.
Okay. Mr. Nolka, you said that a small part of your capacity expansion will come on stream this year. Can you tell us when will the entire capacity expansion come on stream? You have it planned in spinning, knitted fabrics and woven fabrics as well, all three of the segments. By when will it come on stream? How much revenue addition do you expect from there? And do you ever think of forward integration, getting into garmenting as well, because you are there across the value chain already?
First of all, our expansions plans will start to kick in from the last quarter of this financial year. We have our weaving and knitting and processing expansions will be on stream within this last quarter of this financial year. Our spinning expansions will be coming in the first half of next financial year. They will be evenly spread. So we expect that we should be able to complete our expansions by September of 23. Further, from this expansion, we are aiming at a revenue growth of about 1,200 crores. So that should fully fructify in the year FY25. Partly it should be also there in the FY24. Now coming to your question of garmenting, we have not yet, let's say, visualize on that part. We are still focusing on value addition of yarns as well as fabrics. Since we are present in all segments, that is something which we have to ponder about. We have not yet thought about it. Initially, we were thinking to go with some PLI schemes, but they were not in tune with what our products and our product mixes. So still, we are yet to decide on that part of the business.
Okay, all right, Mr. Nolkar, it was a pleasure speaking with you. Thank you so much for joining us and giving us details about what's happening in the industry and also in your company. Good luck for your future plans as well.
Something like a UCO Bank is down 1.5% as well. Back to you.
Thank you very much for that. Let's invite Shrikant Chauhan, the Executive Vice President of Kotak Securities now to talk about the market technicals. Shrikant, we've slipped below 17,900. It's not a big cut, just down about 50 points in the Nifty. Nothing compared to the kind of rally that we've seen. So the profit booking seems par for the course. But your thoughts on the day, is this dip to be bought into?
I think, see, like after hitting these levels of 18,000, which are like very close to those levels, I'm expecting market to consolidate. It will take some more time to cross the levels of 18,000 because in the morning, the market was very close to those levels, but still it failed, even though the Bank Nifty managed to make a new high. So one thing is very clear that maybe in the near term, we may see the levels of either 17,800 or 17,750, where the market is having excellent support. But certainly, it's a market where we need to buy if there is any specific correction in the market or if the market falls to the important support levels. So between 17,800, 17,700, certainly we should be buyer. But at current levels, around 17,900, we need to be careful. So let the market come down to the important levels.
Okay, and Shrikant, in a market like this, what would your individual technical picks be?
Yeah, I think definitely we should look for mid-cap companies because if the market is going to consolidate, it is not going to fall heavily, then we need to focus on those stocks where the beta is very, very high. And in that particular basket, we like Godrej Consumer, which is currently around 915, 914. Some 2 days back, the stock was around 950, 960. From there, all the way corrected back to the levels of 900. But the overall momentum and overall trend of the stock is still very, very strong. We are expecting stock to move towards 1,000 levels. We can keep stop loss around 900 for the same. The other stock which we like is from the chemical basket, and that is Sumitomo Chemical, which is currently trading at 488, 490 something. There we are expecting 520 or 530 sort of levels, and we can keep stop loss around 474.
Shrikant, thank you very much for that. Markets right now undecided. It's unable to climb on to higher levels, but the dips so far are being bought into. Let's get you some fundamental opinion on the markets and the way forward. Earlier today, we caught up with Andrew Holland, Chief Executive Officer at Avendus Capital, Public Markets, Alternate Strategies, to understand how he's reading the markets right now and what the view is.
We could stay higher for longer, but it's all markets, including ours, are looking very overbought. I think the Goldilocks scenario, which people are trying to bake in, is probably not going to turn out to be that at all. So I think it's whether it's a bear market rally for us, but certainly globally, I think it is. So you could see a downtick from here because the Fed minutes were not conclusive, shall we say, in terms of what they were trying to say. So I think the Fed will have to do more in terms of rate increases and get the aggregate demand down, because it's certainly a problem, I think, for the US. The trend for the auto sector is demand is there, that's for sure, and with commodity prices having kind of eased a lot, probably will continue to ease. That's going to be the tailwind for the sector. So I think whilst I'm saying that, it could be one of those which will see some profit taking. Banking and autos and consumer discretionary are sectors which, if there is a fall led by these sectors, is where you should be picking up, because I still think the deflation trade is going to play out by the end of the year, and that leads to these sectors. So I haven't moved away from that. I'm just worried about some of the things which the market's trying to just take in its stride and say everything's going to be okay. The IT stocks are going to be really a hostage to what happens to the tech stocks in the US, and that's been playing out for some time now. The correlation is very high. So if you have a very positive view that the tech stocks in the US are going to start doing well, which I don't, then I think this rally in IT stocks again will probably fade as markets correct and tech stocks correct in the US, because I think that's where the most pain I think will be felt in the US economy. IT is probably I just don't think there's enough tailwinds for the sector, given that it's just following what's happening in the tech stocks in the US.
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. While the benchmark or the headline index is not doing so well, a couple of stocks in the broader markets which have moved to the highs of the day. Something like an India Cements, which is up 4.5% as we speak. A lot of buying at larger volumes is what we are seeing for India Cements as we speak. The other one is BHEL. That stock is also up 4%. And some of these consumption names, the likes of Jubilant Foodworks, we have Tata Consumer Products, Godrej Consumer, all these stocks are also surging up anywhere between 2 to 4% as we speak. So a lot of buying in these consumption names is what we are seeing today. But it's time for a special segment now, Midcap Spotlight. Abhishek Kothari will focus on a midcap stock that is reacting and is in news today. Abhishek, what is driving the stock?
Well, Repco Home Finance is on radar. Now, what is driving the stock is the fundamental improvement that you have seen in its results and the management confidence in the con call yesterday. So, asset quality stabilizing in a quarter, where asset quality deteriorates, that is Q1 versus Q4. This time around, we have seen an improvement in its gross NPA ratio, which has come down to 6.4 versus 7% in the previous quarter. The credit cost of provisions are also stabilizing, YOY and quarter on quarter, the provisions are down, and it's about less than 24 crores when compared to about 61 crore in the previous quarter. Valuation wise, Repco Home Finance trades at a mere valuation of 0.6x price to adjusted book value FY23. We have a note on it from SDFC Securities. They have an ad rating with a target price of 274, which has come down from 290 that they had earlier. They say that the tide is turning for the bank, for the company, and sustainability is the key over there. They also say that Q1 FY23 earnings have surprised on the positive front after disappointment performance that you have seen over the last few quarters. So leadership team has actually launched several initiatives to drive the portfolio growth. New management sounds very optimistic in terms of sustaining the double-digit loan growth with healthy asset quality. So these are the few parameters which is leading to stock rising in trade today. Back to you.
Thank you very much for that. Moving on to auto parts maker Precall, which has hit a fresh 52-week high today. Sonia is here with more details. Sonia?
So this is a stock we don't talk about very often, so I thought I'll just profile this stock. It's up 47% in 2022 already, and it's hit a fresh 52-week high. Now, it is into precision engineered technology. So it provides technology to auto companies, and it's now getting into electric vehicles as well. It has all the top clients. Any auto OEM you talk about, it features on its client list, including Bajaj Auto, Hero MotoCorp, Mahindra, BMW, Royal Enfield, TVS Motor and Yamaha. But another trigger for this company is that recently it entered into an agreement with BMS PowerSafe, which is a part of a startup group based in Europe. Now, the company said in their conference call that this is a new product that will help increase place in the EV portfolio of products. A BMS, which is battery management system, is eventually going to play the role of an engine in a vehicle in an EV because the fuel is provided by the batteries. So the battery management system, which is a hardware plus software put together, will come on in control with the vehicle. Now, if they're getting into this space, it means that they will get more EV orders. They in any case have orders from the likes of Tata Motors, etc. in the electric vehicle space, and now they're looking to boost their presence over there, which is a positive trigger for them. Another thing is that the company has successfully reduced their borrowing. Their borrowing is now just about 65 crores, and in their conference call they mentioned that the guidance is to become debt-free over the next few months. So these could be a couple of reasons why the stock has done well over the last few months. Back to you.
Okay, interesting details there. Sonia, thanks a lot for giving us all those all the analysis on Precall, the stock which has hit 52-week high. There is another stock which is on my radar today. It's Pinol X Cables, where Jefferies has cut the target price on the stock to 600 rupees per share from 750 rupees per share. They say, yes, Q1 FY23 profits, they were a beat versus their estimates. Margins improved despite the volatility that we saw in copper prices. They have also broadly retained their EPS estimates. However, they think that the current volatility that we are seeing in commodity prices warrants a caution, and that is something that will impact companies' margins as well. For FY22, FY25, they estimate companies' sales to grow by 14%, profit at 16%. That is on a compounded annual growth rate basis. They maintain target PE at 16 times, which is broadly in line with the company's historical valuations as well. 5-year average multiple, that is. A key monitorable for the stock from here on is the family tussle within the Pinol X group. What is the outcome of that is something that will define the stock move as well. They forecast a 13% sales CAGR over the next 3 years. However, they have cut the target price, and margin caution is something that they are expecting as far as Pinol X Cables is concerned, Reema.
Okay, but with that, we're out of time completely on Midcap Radar. Thank you for watching. Your stocks when we return.